Hey folks, this is Sean Chell from Reliant Wealth Planning. I hope this finds you well. In this video, we're going to talk about some adjustments that we have just made inside of the portfolio, specifically in the U.S. stock portion of the core portfolios. So let's get started. To understand, we need to start with looking at what are large U.S. stocks and some of the indexes that track that. And a good stand-in that's often used in the media and you'll hear about on TV and in different publications is the S&P 500. So the S&P 500 is used as kind of a proxy for large stocks in the U.S. stock market. What the S&P 500 is an index, and that means it's not actively managed. So there's not a manager that sits and decides this is a good stock, this is a bad stock. It's an index, so it's a formulaically designed list, and it's made up of approximately the largest 500 stocks that publicly trade on U.S. exchanges. So that's what the S&P 500 is. And it's important to understand that those 500 stocks are not owned evenly. So stock 1, there's not the same amount of that as there is in stock 500. They're owned in different amounts. And the way the S&P does that is the more the total company is worth, the larger part of the index that company makes up. And that's called being market weighted. And that'll make more sense on this next slide. So here's a list of the top 10 largest stocks in the S&P. And right now there's actually 504 stocks in the S&P 500, just to be a little confusing. But here's the top 10 stocks of those and how much they make up of the index. So you can see, no surprise, Apple is the single largest holding in the S&P 500 because Apple is the largest company in existence. And of that index of 500 companies, you can see it makes up about a little more than 7% of the entire index. So to think about that, here's what we've got. So these 10 stocks of 504 stocks make up a little less than 2% of the S&P 500 in the number of names. So there's 504 names or companies in the S&P, and 10 of them make up less than 2% of the overall index. However, if you added up all these weights, just those 10 names that are less than 2% of the companies in the S&P make up 35% of the overall value of that index. So by the time you get down to stock 504, it makes up a minuscule amount of that index. Now, the fact that that looks that way, that's kind of a caution sign. The fact that just 10 stocks make up over a third of the S&P's value means it's very, very what we call top-heavy. These 10 stocks have a very overweighted impact on how well the S&P does, either good or bad. And if you look at these names, you might notice something else. Of the 10 stocks, 9 of them are all tech stocks. And not only are they tech stocks, the 9 of them are heavily involved in a niche area of tech known as AI, or artificial intelligence, which you've probably heard a lot lately. Artificial intelligence has been on a tear over the last 2 years, and that's pushed up the stocks that are most involved in it. That's why we see the S&P as we do today. 9 of the 10 stocks are somehow involved in AI, and like I said, that's been good so far. If you own these stocks, you've made a lot of money. But there's a caution sign about that because that means a very niche area of the market is controlling a very large portion of its returns. Now, that's the S&P 500. There are different ways to index the stock market, just to be confusing. And another very popular way is what's called the S&P Equal Weighted Index. What's interesting about that is it's made up of the same 504 stocks. So if you looked at the names in the S&P 500, it's the exact same names in the S&P 500 equal weighted. However, there's a big difference. Instead of them being weighted by their market cap or how big of a company it is, they're each owned equally. So how much money is in stock number 1, like Apple, is the exact same amount that would be in a stock like, say, Harley-Davidson or ExxonMobil or any other company in the S&P 500. They're each owned exactly the same. So I think a good analogy to that is the difference between a brownie and a chocolate cake. The way at the basic level these things are made, they both have the same ingredients. There's sugar and flour and cocoa powder and eggs. It's the same ingredients, but they come out to be 2 different desserts because the ingredient amounts are different. For instance, in most recipes, there's more eggs in a cake than there is in brownie. and they're cooked differently. So it's the same ingredients in different amounts prepared differently, and you end up with a different dessert. That's kind of like the S&P 500 and the S&P 500 equal weighted index. They're the same ingredients, they're just combined differently. So one's cake, one's a brownie. I'll leave it to you all to figure out which of those you think is better. I personally like cake and I don't like brownies, but that's just me. So to look at this, so that means the top 10 stocks in an equal weighted index make up approximately 2% of the index, both in the number of names. So the top 10 are 2% of the companies in it, and they also make up 2% of the value, unlike the S&P that those 10 names make up 35% of the value. That's a very different thing, even though it's the same stocks. So why is that important? Now, this gets interesting. So let's look at this chart. First, let me help you learn how to read this chart. This is measuring the difference in returns between the S&P and the S&P equal weight. So these are not what either of those indexes did in a year. So for instance, look at 2003, and this says minus 12. Well, both the S&P 500 and S&P equal weighted were up very well in that year. Both of them were up over 20%. So a positive, up 20%. So this isn't showing either one of them was negative. It's saying, hey, the S&P did 12% worse than the S&P equal weighted. That's what this is measuring, the difference in returns between the S&P and the S&P equal weighted. So just because these are negative numbers doesn't mean either one of the indexes were negative, and the reverse is also true. Just because there's positive numbers doesn't necessarily mean either of the indexes were positive either. It's just showing the difference in returns. So let's look at this. This is about 34 years, going on 35 years. Let's look at some history of this thing. So that's a third of a century of data here. So here's a time where the S&P really outperformed the equal weight by almost 9%. And here's a time frame over a couple of years it outperformed very well. Here's an outperformance, not as strong as the other ones, but it's a definite trend. Here again, we see a trend there on outperformance of the S&P versus the equal weighted. Now look what happens each time in history after something like that occurs. There's then a reset. A time where, to use the real technical term, there's a reversion to the mean, meaning, hey, the S&P doesn't always outperform the equal weight. As a matter of fact, over as long a period of time as we can measure, the equal weighted S&P has done better than the regular S&P. So anytime the S&P 500 really takes off for a while, there's going to be a time of reckoning where the S&P equal weight really outperforms. And if you look at at least over this third of a century, it's the equal weighted outperformance lasts longer and is bigger numbers than when the S&P was outperforming the other one. So you can see that there. This next one here, that's the tech bubble, 98, 99. That's the tech bubble, which really pushed up the outperformance of the S&P because, again, tech stocks pushed it up. But then look at that. Almost 6 years out of the next decade, almost 7 years, the S&P really underperformed the equal weight by quite a bit. Then you see here's the Great Recession. Leading into the Great Recession, S&P 500 outperformed, and then the equal weight really caught back up to it and lapped it in performance. Then we have this time right in here going into COVID. S&P 500 was outperforming, and then equal weighted outperformed that. Now, look at where we are today. This is today. So that's a really strong outperformance on the S&P. That's been driven by those AI tech stocks, really focusing in on the kind of highest end of the S&P. Again, 9 of those stocks are 34% of the value of the S&P. At a time like that, you can look back in history and say, at least historically, what's about to happen is the equal weighted S&P is about to outperform quite possibly for years. This isn't the largest outperformance of the S&P to the equal weight. That was back at the tech bubble, if you look back here in 98, 99, but it's close. That is giving warning signs of, hey, there's probably about to be a change in market leadership. Don't know when. It could be next month. It could be once we enter the new year. It could be another year from now, because sometimes that can go for a while. But once it really starts to peak like that, you can see it doesn't last very long until what's leading the market really changes, okay? Here's a different way to look at the same kind of data in different time frames. And if you're more of a numbers person than a visual person, you'll like this one. This column right here is showing, okay, here are, instead of in the last chart we were looking at annually, this is in 3-month blocks of time. This is saying what are the largest 3-month blocks of time where the S&P really outperformed the equal weight. So that's what this is doing. It's showing you, hey, what was the end of that 3-month period of time right here? And then it's showing you, hey, over that 3-month period of time, how much better did the S&P do than the S&P equal weighted? Okay. So that's these times. That's the biggest 3-month time frames in this same time frame, in the same 34, 35 years. Now look at what happens in the next 3 years after those. Now, if there's an NA, what that means is there hasn't been 3 years after that time frame. Like the top one here, that end date was March 2023. Well, we haven't had 3 years since then, so it can't measure that. But in every time frame, if you'll look, that we can measure at least a 3-year time frame after, the equal weight has done better, and not by just a small amount. By very large numbers does the equal weight then outperform the S&P, and that's over 3 years. You stretch it out over 5 years, it's even more that the outperformance really shines. So history is telling us we might be coming into one of these time frames where the S&P has done very well, and it's time, though, for that to start giving some of that back, or at least for the equal weight to really start outshining the S&P itself. Again, that doesn't mean anything's going to go negative over the next 3 or 5 years. That's not what that means. It just means the S&P equal weight tends to then outperform the S&P itself by noticeable amounts in time frames like this. Okay? There are 2 major reasons this kind of thing occurs, and that's this. The equal weight is much less concentrated at the top than the S&P market weighted. So that concentration, the thing about concentration is sometimes it helps and sometimes it hurts. So over the last 2 years, that concentration has really helped because the stocks that have really worked well are the AI tech stocks. So if you were focused in those, you made a lot more money. That's great. The thing about that kind of focus is it always changes. Always. It never stays the same. So there's going to be a time where the AI stocks aren't the things doing the best, but the S&P is still going to be focused at the top on those for a while. So that concentration is really going to hurt. So something that isn't as concentrated is going to look much better. So it's the fact that it's not nearly as concentrated. And there's another dynamic going on there too that might not be so obvious. And that is there are different amounts of mid and small cap stocks in each of those. In the U.S. market, all stocks can be categorized by size, and there's basically 3 sizes people use: large, mid, small. It's very complicated. And the S&P 500 has all 3 of those in it, large, mid, small. So does the equal weighted. And it's got the same stocks. Remember, each of these indexes has the same stock. It just has different amounts of each stock. So the S&P 500 is actually 18% mid and small cap stocks. A lot of people think the S&P is all large cap. It's not. It's about 18% mid and small cap stocks. However, the equal weighted is about 67% mid and small cap stocks. That's another reason you see these changes in which one's doing better. Sometimes mid and small cap stocks go for long periods of time where they're outperforming their large cap brethren. So between it not being as concentrated, even if you have large caps, you don't have to have just 10 of them. You can be more spread out, which the equal weighted is. And the fact it's not so much in large caps, but better spread out between large, mid, and smalls. That's where you see that difference that we just saw of, sometimes the S&P outperforms like we've been in the last 2 years, but then we enter periods of sometimes very long periods of time where then the equal weight outperforms. So in our portfolios now, on the growth side, the single largest holding we have is something called ITOT, which is the iShares Core S&P Total U.S. Stock Market. So that's a mouthful. We've owned that for a long time. On the growth side, that is our single largest hold. So what is that investment? Of that investment, about 70% of that investment is indexed large cap U.S. stock. So again, it's indexed. There's not a manager picking and choosing good or bad. It's just based off of the large U.S. stocks that exist in the U.S. And it is market weighted. So this is heavy in the top toward AI stocks. Because again, the market weighting means, hey, the bigger the company, the more it is in the index. So that's 70% of this investment. The other 30% of this investment is in indexed mid and small cap stocks. So again, there's no manager choosing these things, but it's just the largest mid and small companies. That makes up about 30% of that investment, okay? Based off what we're seeing in the market now and based off the history, and it's a long history, I showed you the last third of a century. It goes back farther of this natural kind of ebb and flow, which one's doing better. We reached the conclusion that it is time to sell this investment, this ITOT investment. And we're going to sell it. Now, we're not leaving the stock market. What we're doing is we're going to take the proceeds and invest it a little differently in other investments. Here's what we're trying to accomplish with that. For the 70% in the large cap stocks, we're trying to break up that concentration, okay? Because what we're trying to do is, of the large cap stocks, U.S. stocks, we don't want just 10 of them making up such a big portion of the hold. So we're going to break it apart so that just those 10 stocks don't make up 35% of the portfolio. And we're also going to take some of that money that's in large cap and move it back down to small and mid caps, because we saw that was a major driver too of why the equal weighted really outperformed at periods of time, was because of the amount of small and mid cap stocks they held. So we're going to reallocate some of that money down to the mid and small. And the money that's in the mid and small, like we said, we're going to add to that overall exposure. And also what is being indexed now, we're going to add more active management. In the small and mid cap space, an active manager can actually, we think, add more value than they really can in the large cap space by picking the winners and losers, so to speak, trying to stay away. Really, the way they add the best value is stay away from the worst of the worst. As long as those aren't in there, they can make a noticeable difference in their returns. So this is what we're doing. We're selling ITOT. We're going to break it apart, and this is what we're trying to accomplish. Don't be so concentrated in just 10 stocks, and then try to kind of spread out a little more money into the mid and small cap space. A couple things about this trade that's being done. One, the trade's mainly being done in retirement accounts for tax reasons. So again, we're not selling ITOT because it's done poorly. As a matter of fact, it's done fantastically well. Because of that, there is a lot of unrealized capital gains that are baked into that. So in retirement accounts, we can sell that and it's no tax consequence, because in either tax-deferred or tax-free accounts, we don't have to realize the gains when we sell. Inside of a taxable account, that could be a brokerage account, that could be a trust account. If we were to sell ITOT just across the board in there, we'd be realizing a ton of taxes, and we don't want to just do that willy-nilly. So for now, we're limiting it mainly into retirement accounts. Having said that, on a case-by-case basis, we're going to make decisions on whether we should do this trade in taxable accounts. And when I say case-by-case, I mean client-by-client, because each of you have different tax situations. Each of you have a different spread of where your money's at. So before we do trade it in a taxable account, we're going to have to look at each individual situation and decide, hey, do we think this works or doesn't? Whereas the retirement accounts, we could do it all in one fell swoop. So that's what's going on there. And what we've mainly been talking about is the large U.S. portion of the growth side of the core portfolio, right? Which makes up a pretty good chunk of it, but there's other parts of the portfolio. And just so you know, this trade, we're really not going to make any adjustments on any of the other sides of the portfolio. And what I mean by that, for instance, international stocks make up about 25% of the core portfolio on the growth side. We're not changing that percent. It'll still be 25% of the growth side of the portfolio. And we're not going to change the actual investments we're using to get into the international stocks. We're perfectly happy with what our choices are there. We think they've been performing well. So there's not going to be any changes. There's not just a growth side of core portfolios. There's also a defensive side. For those of you all remember, about 2 years ago, in the beginning of 2022, we made some major shifts in the defensive side because what we thought inflation would do with interest rates. And that came true. That was one of the situations where what we thought happened basically played out the way we thought. We're perfectly happy with those changes that we made there. They continue to work and continue to do well, so we're not going to make any changes there. And then lastly, with TAPA, the Tactical Allocation of Portfolio Assets. We're not making any changes there. It's doing what it's supposed to do. It actively changes how much is growth versus defensive and the areas of the growth market and defensive market it's in. So it's kind of taking care of itself in this. So we're not making any changes there. So as I said, these trades, one set of trades has happened today, which is October 28th. There's a set of trades done there that you would see in your accounts. There's going to be a phase 2 of this where we make one more set of trades where we sell the rest of ITOT that we didn't today. We expect that to come in the next week or two. We're waiting on the investment that is going to go in to open up. So this is going to happen in 2 phases. The biggest phase 1, has been done. There'll be a smaller section of that phase 2 that's going to come shortly. Just wanted to keep you updated on our thoughts, what we're doing, that we're trying to make sure that we're keeping these portfolios relevant for the market environment that we're in, to try to make as much money as possible, but also protect our capital as we do it. Okay? Hope you have a great day, and I'll talk to you again later.